which is an investor and analyst call, which is open call for everybody. And here we'll be talking about quarter and the year performance of the company, Blue Dart Express Limited, and console numbers of Blue Dart Group. So, as you know, I'm sure most of you would have seen the result. Especially, let me start from the top line. From top line perspective, there is a good growth on the top line, which is in high double digit, which is about 20%, 21% growth on the top line for standalone, which is coming with a healthy mix of volume and realization improvement. Though we know that there's a difficult situation, be it a geopolitical scenario, and still risk of pandemic is not over. We are hearing here and there, and especially in outside India, again wave 4 has been making noise, especially in our neighboring countries. But then we hope with the vaccination which India had probably will give us protection. So going forward, also we would probably not see impact as much as other countries are seeing. Coming back to the quarterly performance on the bottom line side, I think Ebitda performance has been quite good, healthy, margin, which is about 25% or over 25% growth over last year, same quarter YOY, with the 226 crore of Ebitda, and margin also improved at 19.4% versus last year of 18.6%. If you talk about full year performance standalone, I think we have first time record that we crossed 4,000 crores. So currently 4,409 crore top line growth, which is with 34% growth over previous year. And similarly on, we being a fixed cost company and having operating leverage. So obviously we've seen good amount of Ebitda, which is about 696 crore Ebitda, which is 92% growth over previous year. PAT stood at 376 crore, which is again almost 4 times of previous year, which was 96 crore. So this year has been quite good, not only from the perspective of healthy demand in the market, and since economic indicators have been good so far, and they look positive even going forward. So as a result, we had a good volume growth, coupled with the better realization has helped us in high growth in top line. And point to be noted here is that even last year we had a very good growth in this quarter, and with the higher base quarter again this year, the performance has been quite good. Coming to console number, I think console number also has been quite reflecting the same sentiment what we spoke about on the standalone basis. So on console, though on the face of it, you might see a slight drop in quarter for the margin, and that is actually not a drop in margin. It's because of interest cost being lower. As you know that we had undertaken financial reengineering. As a result, our borrowing had got down, and when you since we have a Blue Dart Aviation as a wholly owned subsidiary company, and we operate through ACMI agreement under which all the costs are cost plus markup is borne by Blue Dart Express. So that is where since interest cost is lower, so since Ebitda in consolidation interest cost goes down the line, and since that interest is lower, so obviously in the consolidation that technically shows a lower margin. But if you look at PBT and PAT number, both are showing healthy growth over previous year, and that's what I say that it is because of the technical reason of lower interest cost being there, because borrowing having reduced, and also we had done interest rate renegotiation, because of which interest cost had gone down. On a console basis full year, if you look at it, we have improved Ebitda margin from 20.7% to 22.6%. And similarly, our margin on a PAT level also has increased from 3.1% to 8.7% on console basis. Because of this good performance, our EPS has improved from 40 odd rupees to almost 160 rupees. On a standalone basis, 158.65. And that's where we have the board of directors have proposed a high dividend. We paid interim dividend of 25 rupees in between, and another 35 rupees is a proposed final dividend for the year, which will take dividend to be 60 rupees, or we can say 600 percentage. This year, during pandemic, we had started charter operations, which are international charters. This year also that has continued and supported us in generating revenues. We have seen very encouraging result. Yes, the portion wise is a very small portion still, but probably if this trend continues, this may hold good promise for us. But at this point of time, it's very, very small proportion which you have on the charter side. On due to improved profitability and improved receivable management, we had a good amount of cash flow. So we paid off all the borrowings with the bank. As we speak, there's nil borrowing from any of the banks. In Blue Dart Express, actually Blue Dart Express becomes a debt-free, and Blue Dart Aviation also technically debt-free, because they have 200 crore loan from group company. But more than that, we are holding cash in the balance sheet. So obviously, from that point of view, that is also debt-free. Then I'll move on to what we think from future perspective. I think barring the risk of wave 4, and also maybe the inflationary risk which we see because of geopolitical situation, crude prices going up, even metal prices going up, that could have some impact on the production, on the manufacturing industry. As a result, there could be some impact to us, but otherwise, if you keep for the time being, if you discount them, then otherwise all economic indicators, including government plans of improving infrastructure, improving efficiency, Make in India, all this put together holds good promise for logistic industry, and that's where we are cautiously optimistic about future. As we move into new financial year. With that, I'll take a pause and maybe we'll start question answer session. Over to you, Alok. Thanks.
Thank you so much, sir, for the opening remarks. We'll start the Q&A session. So anyone having questions can please raise their hand or pose the question in the chat box below. So sir, we'll get started. So first question, sir, we take from Mr. Pulkit Patni. Please go ahead.
Hi, can you hear me?
Yes.
Yeah, please go
Hi,
ahead.
hi, Pulkit.
Okay.
Hi, Pulkit.
Okay, hello, sir. How are you?
Fine.
Sir, very good numbers. I just wanted to understand the realization bit. So if I look at the last 3 to 4 years, we were at about if I just divide the revenue by the number of parcels, we were at about 135 to 140 rupee per parcel kind of a revenue realization. In the last 2 years with the pandemic, we've hit that number to about 170 rupees. Now, I understand it includes some bit of, these charters and some special business. Can you give a sense of how this number should trend going forward if we assume a normalization in a post-COVID world? How should that realization number look going forward?
Pulkit, I think let me give you a little more clarity on the realization part, which you just mentioned. So, as far as realization is concerned, as you know that every year we have been announcing GPI, that is to cover inflationary costs. And because we know that in India, inflation continues to be in 5 to 6% range. So to offset that impact, we do take a GPI every year, which becomes a structured exercise for last 3-4 years. But when you calculate realization per shipment on a macro level, because of our product portfolio, which are different kind of offerings are there, probably may not give you right picture. While there could be realization increase, but if there is lightweight shipment, especially say documents, if that increases, probably it may not give right picture, documents or even retail shipments. So macro level calculation of realization per shipment may not be right way of looking at it. It is a function of various combination of shipment which are carried from light to bulk, And when I say bulk is like it could be 1 ton, 5 ton shipment. And if you, since it will be counted as one shipment, so revenue of 5 ton shipment, if you take, it'll distort the picture. So my suggestion would be, rather than looking at this realization, which may not give you right picture, need to look at overall profitability point of view, because currently for each of the offerings like ground, e-commerce, or air, there's no such information which is in public domain which could be used to calculate realization per shipment. And this is a unique position for Blue Dart. Unlike if you talk about e-commerce companies, they have same kind of shipment, same profile of shipment. And if you talk about the bulk areas on ground, they have one offering. But since Blue Dart is in unique position and have all the offerings, so air, ground, and e-commerce, probably this may not give you right picture.
Fair point, sir. Completely understand. Let me just rephrase that part. See,
Sure.
what I'm trying to understand from here on is
Yeah.
that we had some bit of cargo that came to us because we were in a unique environment of COVID, right? Where courts were closed and a lot of lawyers were getting files through Blue Dart. And, these examples, which going forward now, some bit of it reverses as we are looking at pretty much everything being reopened. So I'm just trying to understand from that standpoint, did that element have anything to do with your realization number? That's what I'm trying to understand. I completely understand we are a company where there are multiple products, multiple weights, so it's difficult to pinpoint. But because the jump that I see from 140 to 170 happen in 2 years, I just want to understand where does that trajectory head from here on?
I think that is coming more from the product mix. And the thing which you spoke about, file moving, I think those are now behind us, because we are now in a almost normal situation where everything is opened up. More so when you talk about courts not working, at that time people getting files from court, I don't think so many files we moved from that perspective. But having said that, now document business in normal way, because now offices are opened up. So it is on a growth trajectory, and we are seeing a healthy growth on that side. And with the travel opening up, passports moving, so travel logistic also is coming back in the way it was pre-pandemic. It used to happen. So I think we are in a normal situation currently for last 4-5 months. And that's what has shown stability in our numbers, both on the product side as well as on the margin side.
Fair point, sir. Understood. So my second question is on when do we expect another plane to be added to the fleet? I'm guessing with the kind of volumes you're seeing, we would be operating at almost full capacity at this stage.
Very good question, Pulkit. I think, yes, we are operating at a very high capacity of aircraft utilization. In fact, for charters, we've been leveraging same asset for international charter during daytime, and in night we've been using for our network. And soon you'll get to hear about, we are currently working on this, and that's what mention we made in press release, that we need to expand our air and ground capacities, which currently we are working on, and soon you'll get to hear about it.
Great, sir. Good to know that, and good luck for the future.
Thank you. Thank you.
Thank you. Thank you so much. Sir, we take next question from Mr. Aditya Shirgaonkar. Please go ahead.
Hi, Aditya.
Hello.
Yeah, please go ahead.
Hi. So excellent numbers this quarter, sir. Congratulations for that.
Thank you.
I have a question based on some research reports that I have read. Now, to my mind, it looks like as the economy improves further from here, I would suspect there will be more operating leverage play out and help the numbers for Blue Dart. However, I saw some research reports mentioning that these current margins are not sustainable, and hence they are building in a margin decline in F24 in spite of revenue increasing in F23 and 24. So is it a realistic scenario? Is it possible that economy improves, revenues increase, but negative operating leverage plays out for Blue Dart and margins decrease? I mean, I find it a bit difficult, but what is your view on this this thought that is being floated in some research reports?
Yeah, so you are absolutely right, Aditya. In fact, this morning I read one report. However, they do talk about increase in revenue, but there's no reason given that why the margin will go down. In fact, there has been no discussion or no such interaction with us to understand or to get a perspective as to why this margin will go down. While we have been saying that the cost, rationalization initiatives which we have been working on for last 2 years have started yielding results, and that's why we are seeing margin getting improved quarter after quarter. Having said that, yes, even let's agree to the practical fact that operating leverage is available basis the fixed cost, and you can leverage that fixed cost up to a certain level, and then you need to invest in further capacities to improve the capacities, as just now Pulkit was talking about. So if we need to add capacity, you need to add for a longer term, and that's where initially cost hit happens, but over a period of time it keeps providing leverage because of that fixed cost being sitting in the base. So I guess after a particular level, operating leverage probably goes down because of investment in capacity building. And once the capacity is built and that sits in the base, again you start getting operating leverage. So those kind of scenarios would exist, and it has to exist, because you cannot keep getting leverage out of fixed cost indefinitely, because at certain point of time your capacities would be full. And that's what is happening currently on the aircraft side. And we are talking about air and ground capacities to be built up. There could be short-term impact of those capacity built up, but long-term, story remains intact.
Perfect. Just one more thought. So some reports also talk about how competition will build up, especially from the belly cargo space from commercial airlines. But I thought you had mentioned earlier in one of the previous con calls that commercial airline belly cargo and your operations, they find it very difficult to compete straight away because they are more into the passenger ferry. So do you think this belly cargo from commercial aircraft is a real competitive threat going forward?
In fact, you're absolutely right. I have been maintaining, and I will continue to maintain, that belly cargo is a completely different ball game versus cargo flying and door-to-door time definite deliveries. And the belly cargo thing is not scalable and is a cost prohibitive. For smaller capacities, yes, one can use it, but when it needs to be scaled up, then obviously it does not work. The commercials or the practical operational does not work on a belly space. So that is where otherwise we would not have been adding aircrafts and carrying so much of load in cargo aircrafts. So for a smaller load, yes, it may be there, but that's not a competition because it cannot be scaled up. As we've been maintaining in the past, we continue to maintain for future. For a bigger business, you need to have a dedicated capacity with the reliability, and that can only be offered by cargo aircrafts and not by belly space. And that's why we don't treat that as a part of our competition.
Wonderful. Thank you so much, sir.
Thanks.
Thank you so much. Sir, before we take the next question, we had one question in the chat as well.
Sure.
How much would be the e-commerce portion in terms of revenue for this quarter and year?
So e-commerce portion is one of the important vertical for us, which has been contributing to the top line. So though this information not in public domain, but it is one of the key vertical for us to grow. Right now, we are not providing that information on the how much percentage per se, but on a rough scale basis, one can say roughly about in the range of I would say 1/4 or so. It contributes that much.
Sure, in terms of revenue as well as
Yeah.
Parcel size as well.
In revenue terms.
Sure. And in terms of volume also, if any color on that?
I will not be able to provide that because
No.
that's not in public domain.
Sure, sir. No problem. Thank you. So, sir, we now take the next question from Ankita. Please go ahead.
Sure. Hi, Ankita.
Hi, thank you for the opportunity. So congratulations, sir, on a very good set of numbers. I wanted to understand what is your demand outlook for B2b and B2c, because in anticipation of strong demand is what is driving the the capex plan and higher capacity addition in the air and ground express. So your outlook on the B2b and B2c industry and growth going forward?
So very good question, Ankita. Thank you for it. If you look back on last 5-6 quarters, barring the quarter when we had a wave 2 impact, I think there has been a strong demand basis which we have been growing our top line. And going forward also, going by the economic indicators, be it a forecast from various agencies, and also the government plans on improving infrastructure. So like we know that government has been heavily investing in infrastructure, and there's a multiplier impact of that from the private sector. So if all of that has to happen, coupled with the PM's Gati Shakti plan, where there's a lot more, the platform being created for coordinated efforts to improve infrastructure in the country, be it air, ground, or road, or even railways. And also the kind of investments being spoken about in logistic parks to facilitate and to improve efficiency, coupled with what we are talking about is Make in India or China Plus or Atmanirbhar Bharat. All of this, sounds well, or sounds good as far as logistic is concerned. And as I have been mentioning in the past, it has a double impact on us, because one on supply side, one on the consumption side when the finished product is made. So that holds good promise for logistic company. Apart from this, what we have been talking about of GST benefit due to centralization of distribution, which has not happened. So I think if you take that also, if not now, maybe year, 2 year down the line, that has to happen, because by the time positions taken by people will get settled. So if all of those efficiency needs to come to the books, as government has been talking about 13-14% cost of logistics to come down to 5-6%, or if not 5-6, at least 7-8%. Then all these efficiency measures coupled with the scalability of infrastructure, and also the manufacturing sector, which government is giving boost, including the PLI or incentives for people to produce in India. All of that holds good promise, and that's where we feel that probably going forward demand is going to be strong. Barring if there are some temporary impact of inflation or maybe geopolitical situation could derail. If you discount these two, I think going forward demand would be good, and that's where probably we need to gear up to handle high demand and bring capacity not only on air but also have capacity for handling packages on the ground.
Okay. On which segment are you more positive, B2B or B2C, which can
I
be a
think
growth driver?
both hold good promise for us, because B2C also is essentially we're talking about e-commerce. There's a lot of headroom available from retail spending of about 15% or so in developed countries. In India, still is close to 4%. So there's a lot of headroom available on retail side, and similarly on B2B side also. All this manufacturing, if this is moving to India, holds a good promise. So I think both sector would be having good growth opportunities.
Got it. And one last from my side, what has
Sure.
been the impact of ATF price increase on the financials?
So very good question again, Ankita. The fuel has been quite volatile for last quite a few months, and we all know that geopolitical situation has been impacting the fuel, and handling fuel volatility is not new to us. We have been handling it for almost 2 decades now. That's why we have had a fuel surcharge mechanism in place. So we've seen in the past all volatility, including fuel prices going up to $140, and right now also it's close to $110 or so. So it has effectively provided us hedge against such volatility, and we believe, and which is well settled and well appreciated by customers, and we believe going forward also that will continue to provide us natural hedge by pass on. So it will not impact. It will not have much impact on our bottom line, because that's a complete pass on through the mechanism.
So you mean to say there is no material impact of increase in ATF price on the financials for the quarter and for the full year?
For the quarter and the full year, because we have a fuel surcharge mechanism which provides us a natural hedge.
But it's with a lag. No?
Yeah, there's a 1 month lag only.
Okay. Thank you. Thank you and all the best.
Welcome. Thanks.
Thank you so much. Sir, we take next question from Mr. Krupa Shankar. Please go ahead.
Sure.
Hello, sir. Am I audible?
Yeah, you are audible. Welcome.
Good evening, sir.
Good evening.
Good set of results. Great margins. Just a couple of questions. First, on the employee cost, I can see that there's a sharp decline sequentially. So just wanted to understand, is there any one-offs or any specific reason why it is relatively lower?
Okay, yeah. For the quarter, I think there's a slight lower employee cost as compared to the previous quarters. Previous quarter actually was a festive quarter. That's where we do a lot of temp hiring, and that's why it impacts the wage bill. And this quarter being, not a festive quarter, that's why there's some amount of improvement in efficiency. At the same time, there is a small, reversal of the previous quarter. That's where, because at the month end, when you make a provision, and then sometimes you find that probably it was a little conservative, and that's where a small reversal happens, and that's why for the quarter you are seeing a slightly lower number. But on a year-to-year basis, I think there's a quite increase of about 23 crore, which is what generally we pay out as a per annum kind of a cost for inflation.
Right, sir. So what would be the quantum of that provision reversal which was adjusted in the fourth quarter?
So roughly our wage bill for the quarter is generally in the range of about 135 crore or so.
Got it. So still, if I look at it on a 135 crores, the first and the second quarter also had a fairly higher number. So I guess provision was higher during those.
No. There is one of bonus, which COVID bonus, which was there in quarter 2, and quarter 3 was festive season. That's where we do a lot of temporary hiring, and that's why it was on a higher side on that.
Understood.
Yeah.
Second question also was on specific events which are happening in the market. So we came across multiple media articles stating that there were some integration challenges with respect to delivery and spot on, due to which a lot of the other Surface Express providers gained share. So just wanted to get your take as to where was Blue Dart able to benefit out of this integration challenges of competition.
So I think that integration challenge, I'm sure any such event would have that challenge, and what we understand, that is off late scenario, and not as much as in the quarter which we are discussing currently on the result side.
Right.
Because this is more towards in April or so when the reports started appearing, right?
Right. But yes, sir, but I just wanted to get a directional sense as to whether are you seeing any benefits because of this, and the volumes have remained strong. That's something which I wanted to just get your sense on it.
So I think the scenario which you're talking about is in current scenario, so I may not be able to comment on this at this point of time. I'm really sorry for that. My apologies.
Right. No worries. Just one more question.
Sure.
Wanted to ask also was on the
Sure.
The overall gains what you've seen in the e-commerce space. While what you're seeing is that from a volume standpoint, e-commerce, especially omni-channel, has done quite well, and Blue Dart's presence in the omni-channel is quite strong. So just wanted to pick your sense as to in the e-commerce, what would be a proportion of omni-channel or social commerce vis-a-vis the marketplace, and how are you placing yourself for a strong growth going ahead with respect to infrastructure as well as any other capabilities which we want to add or something?
Sure. So as far as omni-channel is concerned, you are absolutely right. We have very strong presence because that's a value-add situation which customers believe that Blue Dart is better prepared to handle and provide that value, and also enhance customer experience. So from that perspective, I think customers have been preferring Blue Dart, and as some of this information is in public domain already. So all of them have been very strongly tied up and dealing with Blue Dart. And we have been also having new wins also in that space, but since they are not in public domain, I'm not able to quote their names. But then, yes, we are progressing well in that space. And going forward, also we are focusing more on that one, that it resonates well with Blue Dart's value added and better customer experience philosophy, and also provides customers, the omni-channel owners a good sense of value addition to the customer, the loyal customers. So I think it's a win-win scenario for all the three parties in this, and that's where focus continues to remain on growing that space. At this point of time, it is still not a very significant part in the overall pie, but we expect in times to come, it will become a significant part in the overall e-commerce space.
Got it. So,
Yeah.
but the reason why I was asking this question is that given that growth prospects in the e-commerce space is substantially higher, and one can perhaps see that B2B may not follow the same trajectory. With this has sort of an event happening, the mix would be further increasing towards e-commerce if at all that's the case. Then, given that the e-commerce logistics is extremely competitive space vis-a-vis a B2B side. Do you see that the mix itself can have an optical challenge on the margin side? Is that something which is likely?
In fact, Blue Dart philosophy has been all this while to do profit, to do business only with the profit. So we will pick up a shipment with a profitable growth and not compete on pricing, and that's what we have been doing, and we follow that, and we will continue to follow. Having said that, I'm sure you would, if you are monitoring media reports recently, some of the players who were earlier selling cheap or selling lower than the cost, they've also increased prices, because they, at the end of it, sometimes they need to have accountability of doing business sustainably or show profitability at least to the investors. So taking that clue and also going by our philosophy of doing business profitably, I don't see much challenge on margin coming from this front, because we will pick up, and more so when you talk about omni-channel, growth, which will be much faster and much higher, and that's where more of validation is there, which happens at the premium pricing. So I don't see challenge coming from this sector or this section on the margin side. May not have any material impact.
Got it. Thank you, and best wishes, sir.
Yeah,
Thank you. Thanks. So, sir, we'll just take one question which had come in the chat.
Sure.
Just wanted the broad split of air and ground express in the current quarter.
So almost 1/3 would come from the ground.
Sure. And how do we see this mix changing over the next 2 to 3 years?
Meaning going forward, you're talking about?
Yes, sir. Yes.
So going forward, it'll be very difficult to comment at this point of time. But then, yes, ground is growing faster than air. So obviously, there would be some skew towards ground as we move ahead. Now, it depends how the situation pans out. Accordingly, I'll not be able to give you numbers as to what mix we are looking at, but definitely there'll be a skew towards ground.
Sure. And just one last question in the same chat. So what growth rate could be expected, sir, for both these verticals, air and ground?
So in ground side, you can comfortably, going by the current, indicators, high double-digit kind of a growth. And on air side, you can take high single-digit kind of a growth.
Sure, sir. Sure.
Yeah.
So, sir, we'll take next question from the panel. So we'll take a question from Mr. Alok Deshpande. Please go ahead.
Sure. Hi, Alok.
Yeah. Hi, Anil sir. Alok here. This side. First of all, congratulations on a great set of numbers to the entire team, and a great year also. Sir, two questions. One, I think in one of the responses to the earlier participants, you mentioned that there was a small reversal in the employee cost. I think even if you were to adjust for that, I think your margins would be 18% plus. I'm talking about the Ebitda margins. Would you say that is the new normal? I mean, that becomes your base case in a way?
So current quarter, if you talk about, okay, you're saying you adjust and after adjusting, you're calculating the margin.
Yeah. I mean, even if you add back that whatever 8-10 crores to the employee
Yeah.
cost, I think still your margins would be almost close to 18% or even slightly higher than that, vis-a-vis maybe 16.5 or something like that in Q3. What I wanted to know was, is this 18% odd becomes your new normal given the cost cutting measures that we've been taking for the last few quarters?
So a very good question here. Though 18% looks quite high in given the current competitive scenario, but then what I just mentioned about adding capacity and also ensuring that we continue to maintain our customer experience, because we all decision we should take keeping customer in the forefront. So from that perspective, there could be some investments or some operating costs which could get added on automation, digitalization, etc. So I'm sure if not the similar range, around same range, we would or maybe slightly 100 or 200 basis point one can assume, if even if it gets impacted on a conservative side. I think that's the kind of trajectory going forward we'll try and maintain.
Fair point, sir. Fair point. And
Yeah.
sir, you also mentioned Road Express being part of being 1/3 of this. This is, you're talking about the revenue share here, or?
Yeah, I'm talking about range of revenue share.
Okay. And so this is, and the way this is defined is if any parcel goes from destination A to B completely through ground, then only that comes under this 1/3, right?
That's right. That's right.
Okay. And so just one last bit, this e-commerce, I think I don't want to ask the revenue share, but is it fair to assume that the growth that you would be building in for the next couple of years or even after that, in the growth delta, the share of e-commerce would be fairly high, right? I mean,
you're absolutely right. Yeah.
Okay, sir. So thank you so much for your responses, and I wish you all the best for this coming years.
Thank you, Alok. Thanks.
Thanks so much.
Pleasure talking to you.
Same here, sir.
So, sir, we take next question from Mr. Sandeep Bansal. Please go ahead.
Yeah, thank you so much for your time.
Hi, Sandeep. Yeah.
Hi. So my first question is that did I understand you correctly when you said that there is not going to be much impact on margins from a change in mix if it happens? So are we saying that road margins and air margins are roughly similar?
Yeah. So what we do is in our pricing strategy, currently margin, we maintain at the same level almost with a very marginal difference. So if ground grows faster, still it may not impact margin as much as general perception is. You are absolutely right.
Sure. And so would it be fair to say that a bulk of the gains from cost rationalization measures are already reflected in the numbers? Though obviously it's an ongoing exercise, but bulk of it is already realized?
Yes, you are absolutely right. We are in the journey of excellence, and whatever were on the plate, a lot of it has already been actioned, and that's why we are seeing the benefit of that. However, having said that, we continue to explore newer areas, and if you find there's opportunity, we definitely work on that so that we further improve our efficiency.
And so lastly, just to clarify to your previous question's response, you had said that margins could at worst have a downside of 100 to 200 basis points. That was from Q4 levels or from an entire financial year perspective?
So since reference was for the Q4, so the response was in response to the Q4 numbers.
Sure, but applicable for the whole year.
Yeah, could be. Yeah, absolutely.
Okay, sure. Thank you so much, sir, and all the very best.
Thank you, Sandeep.
Thank you so much. Sir, we take next question from Mr. Sanjay Satapathy. Please go ahead.
Hi, Sanjay.
Hi, sir. Can you hear me?
Yes, I can hear you, Sanjay.
Yeah. So, two quick questions. Number one, is that your revenue declined a bit sequentially. Is it because of Omicron wave, or this is a typical seasonality of your business?
I'm not seen the revenue number declining?
Compared to your December quarter.
December quarter, definitely, because that's a festive quarter. Generally, you will have a high revenue. So it's more of a seasonality. So typically for us, the highest revenue would be in December quarter, and followed by September quarter, followed by this March quarter, and the lowest quarter generally used to be our June quarter. And that's how the scenario looks like if you go look in the past.
Okay. And there is no impact of Omicron wave per se.
Per se, in last quarter, no.
Okay. And so, Mike, the other question that is that, as you say, that December is your biggest quarter, but then even if I do all kind of adjustment, still your margin in December quarter was little lower than March quarter. And the point is, it because of the business mix, that is in the festive season, your mix is more towards e-commerce, which is lower margin, and does that explain this margin volatility then?
I think there are 2-3 factors which probably needs to be taken into account. As I mentioned, on the cost efficiency side, we have been working, and then by the time you realize full potential, of initiatives, obviously that has a sequencing impact. So that's one. Secondly, what happens during festive period, we build up additional capacities. So sometimes if all the capacities are not fully utilized, and then that obviously has impact on the bottom line. So this is what exactly happened in the December quarter. We had built up higher capacity, but utilization was not as expected because of lower level of shipping, especially on the e-commerce side during that period, and that's why in that period there was some impact to margin.
Understood. Wonderful, sir. So lastly, if you can just explain that you were saying that you are already operating at full capacity, and that's why you will be adding some flights, etc., to your fleet. You will go through fleet expansion, and that may have some kind of margin pressure. So when is that likely to happen? Like it is being proposed for the current financial year, or it is little further away?
I think on this front, we'll come back to you soon as to what is our plan. Right now, plans are not final, so that's why I'm not able to comment on that.
But what you would rather say that basically there could be some amount of cost dislocation because of that, but
that will be for temporary. That will be for temporary period. It will not be for longer term. It may be quarter or two at the most.
Understood. So as you kind of clarified that you are anyway looking to sustain a Q4 margin with a plus minus 100 odd basis point.
Yeah, that's what is our thought and plan.
And that too with a decent growth outlook for coming year.
That's right.
Yeah. Thanks a lot, sir.
Yeah. Thanks.
Thank you so much. So we take next question from Nemish Shah. Please go ahead.
Hi, Namish.
Yeah, hi sir. Thanks for this opportunity and congratulations on good set of numbers. So I just wanted one clarification. So this we've seen a sequential decline in the depreciation number. So is this because of the aircraft that we purchased, and should we see this as a number going forward to sustain?
Now depreciation number has two things, and primarily for that responsibility comes from the 116 accounting standard. So if you sign new leases, suddenly this number goes up, and if you have new facilities. If you don't add new facilities, obviously sequentially the depreciation number will keep going down. That's point number one. And second impact you rightly identified, because we purchased 3 aircrafts. So earlier those were appearing as a part of ROU asset, which now generally will be depreciated over a longer term. Earlier that gets depreciated over a period of lease term. Now instead of that, it becomes depreciation is over the period of life of aircraft. And also, if you recall, 2 quarters back, we did have some upgrade of the old systems. So old systems were written off.
Understood. And so can we expect the interest cost to also go down accordingly going forward?
Yeah, so interest costs going forward on a console basis would be very low because now since we become debt free, all the debts have been paid off. So if at all interest costs will be within company and that in console will get nullified. So it'll be only the impact of 116 which features as a part of finance cost. Otherwise, there won't be any interest cost unless we start borrowing again.
Right, sir. And so just again on this capacity investment front, so did I hear you correct that you may have to invest to increase your ground capacities as well?
Yeah, so we need to upgrade our hub facilities to handle larger volume. So as we are talking about double-digit growth in surface, so obviously if surface is growing, that much, we need to have capacity built in our hubs for transshipment of those shipments. So it will require bigger space. So we may have to go for a bigger space for building that capacity of handling larger tonnage.
Okay, so and if you can share how much in terms of square feet, any ballpark number that you can share, that how much area you manage, if you can share that.
So currently about more than 3 million kind of space which we have, and for going forward, what we're going to do, you'll get to hear in some time.
Got it. And this 3 million will be for entire operations, or only for ground?
Yeah.
Okay, understood. Yeah, that's it from us. Thank you.
Thank you so much. So we take next question from Ishpreet Kaur from Motilal AMC. Please go ahead.
Sure. Hi, Ishpreet.
Hi, sir. Congratulations on a good set of numbers.
Thank you.
Just wanted to check with you, what would be the share of the documents in this quarter?
So as far as document is concerned, it continues to the similar range what we have seen earlier pre-pandemic, which is close to about in the range of about 1/4 kind of a number.
Okay, so we are back to the pre-pandemic level.
Yeah.
Okay, and just wanted to understand, like you were saying, that the ATF prices are a complete pass-through with a lag of say a month or so max. The realizations for us will move in line with it, right? So what is the kind of a realization growth that we could see? And also if you could throw some kind of a light on the volume growth, because our base of volume growth is very strong in FY22. So how do we look at volume growth in FY23?
So as far as volume growth is concerned, firstly, let me comment on, you're right in my talking about fuel surcharge mechanism, which is passed through and provides a hedge. As far as volume is concerned, I think we have been having high double-digit volume growth, and that's why we, in fact, we started giving numbers about the number of shipments and tonnage carried. But then on absolute number are already there in press release, which you mentioned, that number of shipment which you carried. Overall, it talks about roughly 30% or so volume growth,
right,
and roughly about close to 4% kind of a realization growth.
Correct.
Yeah, which is for the year. Yeah.
Right. So how do we look at it for FY23 as the base is so strong?
I'll not be able to comment on that part because future guidance probably we're not giving. But yes, sense is we will continue to have a high double-digit growth. That's what our current sense is from the economic activities.
Okay, and realization growth may also be higher because of the ATF prices.
Yeah, a similar range or maybe slightly higher than that.
Similar range in the sense of 4 to 5% seen this year.
Yeah.
And also the hike that we take of 8 to 9%, that was again to be taken in the Jan of this year as well. Does that start reflecting in overall, say, at some point of time at 8 to 9%?
Actually, the 9%, 9.6% which we announced is a kind of a benchmark rate. But the effective realization, because some customers have a, depending on volume, they do negotiate and not fully, in that range. So average comes to about between 4 to 5% kind of realization every year for last 3-4 years, which is seen. So we expect the similar scenario to happen in this year, and some part of it is already reflected in the current quarter's number. And that's why we mentioned that realization growth coupled with the volume, healthy volume growth has helped in terms of the double digit or 21% top line growth which we have.
Got it. And again, like you were just saying, you still see a high double-digit growth with a 4-5% price hike seen in realization. And sir, how much could be the capex? Like you were mentioning that we may do some investments. So ballpark, what could be the capex that we can take?
So right now, since we are on drawing board to finalize our plan, I'm not able to comment how much additional will be there. But if you go by the historical number and the earlier plan, it was roughly in the range of 150 crore to 200 crore. But then if there's increase, we'll come back, about it in some time.
Sure. Thank you so much, sir.
Yeah, thanks.
Thank you so much. Sir, we take next question from Mr. Shivaji Mehta. Please go ahead.
Sure.
Hi, thank you, sir, for the opportunity.
Hi, Shivaji. Yeah, hi,
Hi.
Shivaji. Thank you.
So I had a question on the service transport business, wherein one of our competitors, namely Gati, they've been talking about a 3x growth in their top line in the next 3 years, wherein the industry is just going to grow at a CAGR of 12 to 15%. They are, kind of targeting a 3x growth, which will mainly come from them taking away a chunk of the market share from the existing competitors. So just wanted your thoughts on this. Do you see this as a threat, and how confident are you about holding on to your market share?
So I'm not able to comment on what Gati has made a statement on, because I'm sure they will have the strategy how they want to do it. As far as Blue Dart is concerned, we always welcome competition because that helps us, improving our offering to customers. As I mentioned earlier, that our focus continues to be on a customer requirement and making sure that whatever decision we take, we keep customer in mind and keep meeting the customer requirement, and always have a happy customer. So if you have a happy customer, I'm sure customer is going to continue to deal with you as a service provider, and that's what we are focusing on. Having said that, Gati has been in business for so many number of years, right? And the fact that we were the last entrant in this field in 2008 in a premium segment, and we have been growing our market share year after year. Despite of presence of Gati and Safe Express. So I'm sure customers are seeing value in our offering, and that's why they feel comfortable and they continue to appreciate our service. There's no reason for us to believe that going forward that will lose value. So I'm not as much worried about what Gati is making a claim. As much worried about that how do we further keep improving our service quality to customers so that customer continues to deal with us. So we'll rather focus our all energies in improving customer experience so that customer remains happy and continues to deal with us with safety and reliability USP which we have for so many years.
Right. So makes sense. So just one last question again, in the surface transport business, if you can give some color on the margins, how it kind of differs from, say, one end user industry to the other. So say, for example, in e-com versus pharma versus FMCG, how different could the margins be? And also say B2b versus B2C, how different are the margins there?
So since our offering is slightly different, we are not differentiating on the industry type. For us, it is a package which we deliver. So our pricing strategy, be it pharma or be it textile or any other industry, the pricing strategy remains the same. So we don't differentiate basis the industry which we deal with. Rather, we differentiate on the service and reliability and the safety of the package. So for us, pricing strategy remains the same.
Right. Thank you, sir, and wishing you all the very best.
Thank you.
Thank you so much. So, sir, we take next question from Mr. Vipul Shah. Please go ahead.
Sure.
Congratulations for very good set of numbers, sir.
Hi, Vipul. Thank you.
My question is, what is the market share in e-commerce segment?
So, market.
Sorry,
yeah,
sir.
Sorry. Yeah, continue.
Yeah. And at what rate we are growing in that particular segment?
Sure. So right now, market share study has not been conducted because of pandemic, and now markets are stabilizing. So people are now talking about conducting a survey. As we know, earlier we had a market share of about 18%. That's a pre-pandemic we're talking about. But there's a lot of change in customer buying habits, and also growth have been quite high for us as well, especially on the number of shipments which you pick up, or even on the top line side. So right now I'm not able to comment because credible numbers are not available. Once a study is conducted by the market research agencies, maybe I'll be able to share with you. As far as our growth is concerned, I think we have very healthy double-digit growth on the e-commerce shipment side.
And sir, directionally, can you comment on the margin in the e-commerce segment vis-a-vis other segments? I don't want exact numbers, just direction.
Yeah. So as earlier I mentioned that Blue Dart believes in doing business profitably, and we will continue to do that. And I'm sure competition will follow now the same strategy because some of the media reports suggest that now they are also coming in the same league. So if they come and compete on a same level playing field, I think Blue Dart would continue to do business profitably, and also gain market share because of better service delivery and better customer experience. Because right now it was unfair competition, so to say, in inverted commas. Because of PE funding, they've been undercutting, selling lower than the cost, and that's why they've been getting the shipments or the volume. So once they do business sustainably, I'm sure Blue Dart will gain out of it.
Thank you, sir.
Including the margin.
Thank you, sir, and all the best for it.
Thank you. Alok, can we take one last question now?
Yeah, sir.
Yeah.
Sure. So we take the last question from Mr. Pulkit Singhal. Please go ahead.
Sure. Hi, Pulkit.
Hello, sir. Congrats on the good set of numbers.
Thank you, Pulkit. Yeah.
Opportunity. Just wanted to get some clarity based on your response to some of the questions. You talked about high double-digit volume growth and 4 to 5% pricing growth, which seems to suggest almost a 20% plus kind of revenue growth. I'm not able to tie it up with what you said on the ground and air piece. How do you get this kind of revenue growth without air growing in double digits? Because you mentioned air would grow only at high single digits, whereas ground is just 1/3 of your business. So for you to achieve an overall 20% plus would mean ground should grow at 50% plus. I mean, so please help me understand the math. I mean, does this take into account that air will grow at double digits, or what is the understanding?
So firstly, Pulkit, I did not say that we will grow 20%. I said we will grow, maybe double digit, and also we'll have 4 to 5% kind of a realization gain, which we do get in as we have been getting in the past 2-3 years. Having said that, if one goes by indicators, and growth on ground is a high double digit, could be anywhere between 15 to any number. One can talk about 20, 30, one can look at it that way. That's point number one. Second, yes, from long-term perspective, it could be high single digit, but short-term perspective, it could be double digit as well. But then that's what we were talking about. How do we see future? Future could be single digit number on a CAGR basis. And that's what my question was. Yeah, that's what my answer was.
You mean for air, single digit CAGR, but it could be double digits
for short term. Yeah.
Okay, and does this bake into account your capacity expansion plans, or is this even before that?
So capacity expansion will be basis the volume growth which you take. So right now we are talking about volume growth, and even current capacity is not being sufficient. And that's why we are leveraging our asset during day operation. So when we expand capacity, obviously that will help us in one, timely delivery, and second, to cater to the capacity requirement, which will be basis the volume growth.
Understood. So lastly, on the margin bit, if I look at the consolidated EBITDA margins for the last 3 quarters, and I'm seeing last 3 quarters because obviously first quarter was impacted by COVID. So it is close to 24% odd, right? And when we are talking about a business like yours at that revenue level, and you have the kind of revenue growth you are predicting, which is a healthy double-digit revenue growth. And you're also simultaneously talking about competition being lower. They are also focusing on profitability. And the business has high operating leverage as well. So why should margins contract at all? I understand you would look to invest a bit, but wouldn't this mean that from your 24% levels, it should only grow higher? I'm just confused why it should contract.
No, I think the earlier discussion was from standalone basis, and now you're comparing that with the console basis.
Okay. So yes, sir. I'm curious to understand the trajectory of this 24% average EBITDA margin over the next couple of years.
So that could only have some impact, as I mentioned, because of investment requirement for building up capacity, and which could be short term, and thereafter it will start giving leverage the way currently we are seeing leverage of earlier investments.
Right. But the lower competition intensity and higher revenue growth, does it not offset the impact of this investment?
Maybe partially it could offset. We are being slightly on the conservative side because right now, when we presume that probably competition increasing price will give us some benefit, but what if it does not come?
Okay. All right. Great. Yeah. Thank you, sir, and all the best.
Thank you. Thank you.
So thanks. I think we are run out of time now. So thank you so much everyone for joining in, and thank you, Anil sir, for giving us the opportunity to host this call.
Thank you. Pleasure talking to you and interacting with you, and looking forward to having your feedback. If you have any feedback, you can always share with us, maybe through Alok, and otherwise also most welcome. Thank you.
Thank you. Thank you so much. Thanks.